Hello everyone, I'm Hemant Abhishek and you're watching The Right Property Show. Today we'll talk about indexation, which is another key factor that affects the cost of buying and selling property in our country. For starters, indexation is a method of adjusting the purchase price of an asset like property to account for inflation over time. But look deeply and you will find that it also helps determine the tax on property. So let us know more about indexation and how it is calculated. Point number one, what does indexation mean? So indexation is a method of adjusting the purchase price of property to account for inflation over time. So when a property is sold after a certain period, the cost of the property is adjusted to account for the increase in the cost of living during that time. This means that the original purchase price is increased by the cost inflation index to arrive at the indexed cost of the property. Point number two, its role in calculating capital gains tax. So indexation is also used to calculate the capital gains tax that is payable when a property is sold. The tax is calculated by subtracting the cost of the property from the sale price. Here, indexation is used to adjust the cost of the property, which can significantly reduce the amount of capital gains tax payable. Point number three, calculating fair market value of the property. Indexation can also be used to calculate the fair market value of a property, which is particularly important when a property is gifted or inherited, as the fair market value is used to calculate the amount of tax that is payable on transfer of the property. Again, indexation can be used to adjust the cost of a property to account for inflation, which can help reduce the amount of tax payable. Point number four, not applicable to certain types of property. It is to be noted that indexation is not applicable to all types of property. For example, if a property is held for less than 2 years, it is considered a short-term capital asset and indexation does not apply there. In addition, indexation is not applicable to properties that are purchased before 1981, as the cost inflation index was introduced in that year. Broadly speaking, when the price of an old property is adjusted by taking indexation into account, then its purchase cost increases. This significantly reduces the profit margin when you sell the property in present, thereby reducing the payable capital gains tax as well. So this was all about indexation and how it can have a significant impact on the cost of buying and selling property, as well as the amount of tax that is payable on the transfer of real estate. We'll meet again in the next episode with a whole new bag of information on real estate, because getting the right property is your right.